And right now I'm going to show you another company which it's ASGN on assignment. Yeah, and also probably I'll show you the value line report first. That's an example where you can get confused. Uh, just a second. Okay, on assignment, you can see that book value here is $16. So, and that's why I was surprised when I looked at an assignment because uh, the company is smaller in size and the price, and then I can see that book value is $16. So I thought, why is such a big difference? And then I decided to have a look at the real report. We can see actually that if you analyze this company on assignment, they have 19 price earning ratio. So it's like at the highest end if you compare with uh, Robert Half. So it's much higher. Another thing here that it doesn't seem like value line see them growing. So it's 5% to 17% max. Okay. Another thing is level of debt. It's $691 million in debt and 2 billion capitalization. So it's pretty big. So it's about 30% here in debt. Okay, that's another thing. Now, if you look at operation margin, it's 11, so it's not 12. It's 1% less operation margin here. Of course, we need to have a look at net profit margin as well. So I just compare net profit margin. What's the difference? And net profit margin here is 6.7, and there's only 4. So it's quite big difference. Okay, from that point, even though they have same operating margin, but net profit margin is much lower here. It's like nearly, I don't know, not in half, but quite a lot. Okay, now that's a disadvantage of this particular case. Then on assignment doesn't pay any dividends as well. Okay, and but they expect higher level of growth. You can see that if that's why people are happy to pay now, because they believe that the company is going to grow in the same rate which was growing before, and that's 36%. We saw that Robert Half have 24% growth, and here we can see 36% growth. So it's much faster than Robert Half. And investors, that's why they're overpaying for this particular company, because they believe that this company will grow further. But if you look at analysts' reports, value line is can't see that they're going to grow, okay, for whatever reason. And of course, the bigger the company becomes, the more difficult for them to grow with the same rate. You need to understand. Okay, let's have a look at the balance sheet. And that's what you will interesting to see. The long-term intangible assets and goodwill, they represent about $1.2 billion here. And the total assets 1.7 billion, and then they have liabilities. So when you take the total stock shareholders equity is 784 million, right? And if we go to value line, the value line report, that would be showing here on assignment. That would be book value of $16. Okay, but in reality, if you open the proper balance sheet, you will see that it's negative. It's $500 million negative, and that's very very important to see, because it's really dangerous situation. So actually, when you buy in this company, you don't buy any equity. You buy in negative equity. Okay, and if company gets in difficult situation for whatever with the economical downturn and everything, the price of this particular company will go down so quick that you won't be able to catch it, so it's like falling knife would be. So in this case it would be very good to short this position, short this company, because they would be affected big thing, okay, from that particular moment. Okay, and if you look at approximate here calculation, so it's about what, about 40% higher, right? So in like book value, so it's, if you take current, where is book value? book value 16, so I presume it's going to be minus 12, book value minus 12 in reality has to be. So something like that. So you understand why it is important to look at the real balance sheet, because it might give you some understanding. Another thing which is very important to have a look, how company can be in dangerous position. Look, net profit in on assignment is $71 million. Okay, $99 million planning in this one. Their debt right now is $691 million. Okay, they have to pay in 5 years time 489. So it's, and now the question is, so practically everything what they make, they would have to pay back here. So it's practically $500,000 here, and here it's if they take and assuming they make this $99 million, so they would have to pay practically everything what they make in order to cover this debt. If their earnings drops down, they won't be able to meet these requirements, and in 5 years time they will have to renegotiate this. Okay, and if they don't get um, credit from the banks, they would be in really, really big trouble because they don't have any assets to sell and collect this cash. Okay, in total, their debt is quite higher. It's even higher than that. It's another 200 million here on the top of 5 years. So please keep an eye on this particular case. And we can see that net profit margin here is 3.5, so it's even smaller because of debt probably payment. Okay, so that's on assignment.